I want you to picture a scenario. It's 10:30 on a Tuesday morning. You're sitting at your desk, maybe hiding your phone under the table during a meeting, or you're on your couch.
Okay.
You've got your investment app open. You've got the cash sitting there, ready to go. You've done the research. You know you should buy, but your finger's just hovering over that buy button, and you can't do it.
It's the paralysis.
It is. It's total paralysis. You're staring at the screen until your eyes glaze over, and there's this little voice in the back of your head screaming, "What if I buy right now?" And 5 minutes later, the market crashes.
What if I am the absolute last person to buy before the drop?
Exactly.
That is the universal anxiety of investing. It's not just about money. It's about regret. It's that specific fear where you feel like you need to be a fortune teller just to be a decent investor.
You feel like everyone else knows something you don't.
Right.
It feels like you're trying to jump onto a moving train.
Yeah.
You're terrified, you're grabbing the handle at peak speed, and you're just going to get dragged. And honestly, I think for most people, that fear wins.
Oh, for sure.
They just sit in cash. They wait for the perfect dip that they never actually pull the trigger on because when the dip comes, they're too scared to buy then too.
Which is a tragedy for their long-term wealth. Compounding interest needs time, and if you're sitting on the sidelines, you're missing the game. But that is exactly why today's deep dive is so essential. We are unpacking a strategy that is arguably more psychological than it is financial.
Okay.
It is designed specifically to bypass that paralysis. It's called dollar cost averaging, or DCA.
Psychological peace of mind as a return on investment. I love that concept.
It really is.
And we are basing this discussion on a really comprehensive guide titled Mastering Market Volatility Through Dollar Cost Averaging, along with, a stack of data on market timing versus consistent investing.
Right. And our mission today is to demystify this. We want to show you how to turn market volatility, which usually feels like a threat, into an asset.
An opportunity.
An opportunity. And perhaps most surprisingly, we're going to look at the math that suggests doing nothing in terms of trying to actively time the market might be the smartest active move you can make.
So let's get into the nuts and bolts. Dollar cost averaging. It's a term that gets thrown around a lot, on finance Twitter and Reddit threads. It sounds very technical, maybe a little dry.
It does.
But what is it, strictly speaking?
At its core, the definition is incredibly simple. Dollar cost averaging is the practice of investing the exact same amount of money in a target security at regular intervals over a set period of time, regardless of the price.
Regardless of the price. That is the hard part, isn't it?
That's everything.
You're not looking at the charts. You're not checking if the Fed raised rates this morning. You're not checking if the CEO tweeted something weird. You're just buying.
Precisely. You are automating the purchase. Whether the market is soaring or crashing, you put in the same $50 or $500 or whatever it is. And here is a fun little nugget from the research. Back in the day, this was often called the constant dollar plan.
The constant dollar plan.
Yeah.
That sounds a lot more mid-century reliable,
Oh, yeah.
like a sturdy piece of mahogany furniture.
I'm on the constant dollar plan, it does.
But I need you to help me understand the mechanics here. If I'm investing the same amount of money every time, but the price of the stock is bouncing around like crazy, what is actually happening in my account?
This is where the math gets really elegant. And to understand it, we have to stop thinking about the value of the account for a second and think about the units you are buying.
Is shares.
The shares. Think about it like gas for your car.
Okay, I'm at the pump.
You have a budget. You say, I am going to put $50 worth of gas in my car every week.
Right.
If the price of gas skyrockets to $5 a gallon, that $50 gets you 10 gallons.
Okay, I get less gas.
But if the price of gas crashes down to $2.50 a gallon, that same $50 gets you 20 gallons. You are walking away with twice as much fuel.
So, without me having to make a decision, I'm automatically stocking up when things are on sale and tapping the brakes when things are overpriced.
Exactly. In the stock market, when the price is high, your fixed dollar amount buys fewer shares. You are naturally a conservative. But when the price drops, when the market is down and the news is telling everyone to panic, that same fixed dollar amount buys you more shares.
You're being aggressive without even thinking about it.
Right. You are aggressively accumulating, and the result of this fluctuating share count, is that it lowers your average cost per share over time.
So you're not committed to a single price point.
Not at all. You're smoothing out the ride. You're essentially strictly weighing your portfolio toward the cheaper shares because, well, you bought more of them.
That makes sense. It's almost like you're tricking yourself into being a disciplined investor, because the alternative is what most of us try to do, the lump sum panic.
Right. Contrast DCA with the stress of lump sum investing. That's where you take a big pile of cash, maybe a bonus or an inheritance, and you try to guess the perfect moment to drop it all in.
Which is terrifying,
Hmm.
because if you guess wrong and the market drops 10% the next week, you've locked in that high price for your entire portfolio.
You feel like an idiot.
You do.
And the psychological toll of that is heavy. It leads to regret, and often it leads to people selling at the bottom because they can't take the pain. They think, I made a mistake, I need to get out before I lose it all.
And that leads us perfectly into the psychology of this whole thing, because the source material talks a lot about fear versus greed. It seems like DCA is trying to protect us from our own brains.
It is. I mean, we have to be honest with ourselves. Investors are emotional creatures. We are hardwired to be bad at this.
Evolution didn't design us to trade equities.
It designed us to run from lions, right? So when we see a stock shooting up to the moon, we get that FOMO. We get greedy.
We want to buy at the top because it feels exciting, it feels safe because everyone else is doing it.
Correct. That's the greed cycle. We chase performance. And then conversely, when the market tanks, we feel fear. Our survival instincts kick in. We see red numbers, we see loss, and we panic sell because we just want the pain to stop.
It's the classic buy high, sell low trap.
Exactly.
Which is funny because intellectually we know it's wrong. Every textbook says buy low, sell high. But emotionally it feels so right in the moment to do the opposite.
That's what some financial planners call the behavior gap.
The behavior gap.
Yeah, it's the difference between what the investment returns and what the investor actually returns. The investment might go up 8%, but the investor might only make 4% because they jumped in and out at the wrong times. DCA closes that gap.
It closes the gap by removing the choice.
Exactly. It forces discipline. It eliminates the effort required to analyze entry points. You don't have to watch the market like a hawk.
You don't have to make a decision when you're scared.
Right. The decision was made 6 months ago when you set up the transfer. You are outsourcing your willpower to a system.
So who is this really for? Is this just for beginners who don't know how to read a stock chart?
Well, it's definitely great for novices. If you don't have the expertise to judge opportune moments to buy, DCA is a massive safety net. It stops you from making a huge novice mistake.
But the source material emphasizes that it's also for experienced long-term investors. So why would a pro use it?
Because even if you know markets, you might not have the time or inclination to sit there and day trade. Or you might recognize that even pros are terrible at market timing. It's for anyone who wants to build wealth without letting market volatility keep them up at night.
I love that. It's investing for people who have a life. Now, I want to make this concrete. We've talked about the theory, the psychology, but let's look at the math. The source material gives us a really specific case study. Let's call him Jordan.
Yes, the Jordan example. This is really helpful to visualize how the math plays out because the numbers are quite stark.
Okay.
So let's set the scene. Jordan is an employee at a company called ABC Corp.
Jordan at ABC Corp. What's his financial situation?
Jordan gets a paycheck of $1,000 every 2 weeks. And he decides he wants to be responsible, so he allocates 10% of that paycheck, $100, to his investment plan. Every single pay period.
Smart move, Jordan. Paying himself first. So he's got $100 leaving his paycheck automatically. Where's it going?
He splits it. $50 goes to a large cap fund, and $50 goes to an S&P 500 index fund.
Okay.
For this example, let's just focus on that $50 going into the S&P 500 fund. We are going to look at what happens over 10 pay periods.
Got it. So 10 paychecks, $50 deducted from each one into this index fund. That means Jordan is investing a total of $500 over this period.
Correct. Total principal invested is $500. Now, here's the reality of the market in this scenario. During these 10 periods, the price of the fund didn't stay the same.
Of course not.
It started around $10, went up a bit, dropped down, fluctuated. Because Jordan was using DCA, he bought different amounts of shares each time.
Right. So in week 1, maybe he bought 5 shares. In week 3, the price dropped, so maybe he bought 5.5 shares. He's just accumulating little by little.
Exactly. He is buying regardless of the noise. So after the smoke clears, 10 paychecks later, Jordan sits down to look at his statement. He has invested $500. He ended up with 47.71 shares.
47.71 shares. Okay, let's hold that number.
When you do the math, $500 divided by 47.71 shares, his average price paid per share was $10.48.
Okay, $10.48 per share. That number doesn't mean much to me unless we compare it to something. What's the alternative?
Right.
What if Jordan had tried to be a genius and timed the market?
Let's run that scenario. This is the lump sum comparison. Imagine Jordan had that same $500 sitting in his bank account, but instead of spreading it out, he watched the market.
He's looking for the bottom.
Or he's chasing a rally. Let's say he got impatient. Maybe he saw the stock rising and thought, if I don't get in now, I'll miss it. So he dumped it all in during pay period number 4.
And what was the price then?
In our example, the price at pay period 4 was $11 per share.
Oof. Okay, so he buys in at $11.
Right. So $500 divided by $11 per share gives him only 45.45 shares.
Let's pause and really look at that difference. With the DCA strategy, the boring strategy, he has 47.71 shares.
Right.
With the lump sum guess, he has 45.45 shares. He literally owns more of the company just by spacing it out.
Exactly. He owns about 2.25 more shares. And here is the aha moment the source highlights. Even though the share price eventually went up to over $11 in this scenario, Jordan came out ahead with DCA.
Because he kept buying during the dips.
Yes. Those moments when the lump sum investor would be scared to buy, his average cost was only $10.48. He lowered his cost basis.
That is powerful. He didn't need to predict the dip.
He just needed to not stop buying during it. By simply adhering to the schedule, he turned the volatility into a discount mechanism.
It really drives home the point that you don't need to be lucky to get a good price. You just need to be consistent.
Consistency beats luck in this scenario. And the funny thing is, a lot of people listening to this are probably thinking, wait, this sounds familiar. I think I already do this.
I was just thinking that. This sounds exactly like how a 401k works.
That is the prime example. The source specifically mentions the 401k connection. If you have a workplace retirement plan where money is deducted automatically from every paycheck, you are already practicing dollar cost averaging.
You're a savvy investor and you didn't even know it.
You're just following the HR form you filled out 5 years ago.
Exactly.
The money comes out regardless of whether the stock market had a good day or a bad day. You are naturally accumulating more shares when the market is down.
That's why 401ks are such powerful wealth-building tools.
It's not just the tax benefits, it's the mechanism of investment. It removes the user error. It removes the friction.
But let's say I don't have a 401k, or I'm a freelancer, or I just want to do extra investing on the side. Can I still use this?
Absolutely, you can use it. In fact, you should. The source notes you can use DCA for IRAs, individual retirement accounts, or even taxable brokerage accounts. Most modern investment apps allow you to set this up automatically.
Set it and forget it.
You can just check a box that says invest $200 every Tuesday. It's also specifically noted as one of the best strategies for beginning investors who are trading ETFs.
And I've heard of something called DRPs. That sounds like a plumbing issue, but I assume it's financial.
It is. DRPs stand for dividend reinvestment plans, and they naturally utilize DCA principles.
How so?
Well, when you own a stock, sometimes they pay you a dividend a share of the profit. Let's say you get $50 in dividends. You could take that as cash, sure.
Go buy lunch.
Go buy lunch. But with a DRP, the plan automatically takes that cash and buys more shares of the stock immediately at whatever the current price is.
Oh, I see.
So if the price is low, your dividend buys more shares. If it's high, it buys fewer. It's a self-perpetuating DCA machine that accelerates compounding.
Okay, so we've sung the praises of DCA. We've seen the math work with Jordan. We know it saves us from ulcers. But I want to push back a little bit. We have to keep it real. This isn't a magic money wand, right?
No, absolutely not. And the source material is very clear on this. We need an anti-hype check.
Okay.
DCA is a risk management tool, not a profit maximization guarantee. In fact, there are specific mathematical scenarios where DCA loses to a lump sum approach.
Really? So the constant dollar plan isn't always the winner?
No. Let's look at scenario A, the continuous rise. Imagine the market is a rocket ship going straight up.
Okay, so every day the price is higher than the day before.
In that specific world, DCA is mathematically worse than a lump sum.
Because I'm waiting to buy at higher prices.
Exactly. If you have a lump sum of cash today, say $10,000, and the market goes up every single day for the next year, you would have been better off putting it all in on day one.
Right.
By holding back cash to average in, you are just buying fewer shares later at higher prices. You're averaging up, not down. This is sometimes called cash drag.
That makes sense. But how often does the market go up in a perfectly straight line without any dips?
Rarely. But over long periods, like 20 years, markets generally trend up. So there is a statistical argument that says time in the market beats timing the market, meaning lump sum often wins purely on math because the money is working for longer.
But that assumes I have the stomach to drop $10,000 in on a Tuesday.
Correct. And that's the trade-off. DCA might return slightly less money in a massive bull market, but it ensures you actually invest the money instead of sitting on the sidelines out of fear.
Right. The suboptimal strategy that you actually follow is better than the perfect strategy that you're too scared to execute.
That's a great way to put it.
Okay, so that's the risk if the market goes up. What about if it goes down? Scenario B.
Scenario B is the continuous fall, the crash that never ends.
The falling knife.
Right. If the market keeps crashing and crashing, DCA does not protect you from the loss of value. You are essentially carrying a falling knife.
Because I just keep throwing money into something that is becoming worth less and less.
Correct. DCA lowers your average cost, yes. But if the current price is lower than your average cost, you are still losing money.
Right.
It doesn't eliminate the risk of declining prices. It just softens the blow compared to buying everything at the peak.
And this brings up a really scary point mentioned in the source using DCA on a single stock. This feels like a major warning label we need to slap on this.
This is a critical warning. Do not gloss over this. The strategy of dollar cost averaging assumes that the asset will eventually recover and rise. That works for the whole market.
But a single company can go bankrupt.
It can go to zero. Imagine you were dollar cost averaging into Enron in 2001, or a failing tech startup.
You're thinking, oh, look at this discount. I'm lowering my cost basis. I'm getting a steal.
But the stock is going to zero. If you DCA into a company that is fundamentally failing, you aren't being a disciplined investor. You are just throwing good money after bad.
You are efficiently destroying your own wealth.
You are. So the source suggests that for less informed investors, or really anyone who wants to manage risk, the strategy is far less risky with index funds.
Because an index fund tracks the whole market, or a huge chunk of it.
Right. The S&P 500 might dip, it might crash, but the likelihood of it going to zero is effectively the likelihood of the entire U.S. economy collapsing. It diversifies away that specific single company failure risk.
So the strategy really relies on your outlook on the market as a whole.
That is the fundamental assumption. The strategy works mechanically, but it relies on the belief that prices, though they drop at times, will ultimately rise. If you believe we are entering a permanent bear market where prices will strictly fall forever, DCA is not a smart strategy.
In fact, investing at all wouldn't be a smart strategy in that world. We'd be buying canned beans and gold bars.
Exactly. DCA is an optimistic strategy by nature. It bets on resilience. It bets on the long-term upward trend of human productivity and economic growth.
That's a really good point. It's a vote of confidence in the future. So let's bring it all home. If you had to summarize the why for our listener, why should they care about this?
Yeah.
What would you say?
I would say the main benefit isn't even the math. It's the behavior. It reinforces the habit, it lowers the average amount you spend, yes, but more importantly, it drastically reduces emotional stress. It turns investing from a terrifying, high-stakes event into a boring, automated routine.
And boring investing is usually good, right?
Yeah.
We want excitement in our movies, not our portfolios.
Boring is beautiful in finance. Excitement is usually expensive. Remember, DCA is meant to manage risk, not necessarily to beat a lucky market timer who guessed the exact bottom.
It ensures you're in the market.
Yes, in the market when the prices rise, rather than sitting on the sidelines waiting for a sign from the heavens that never comes.
That's the takeaway for me. It's about participation without the panic. It's about minimizing regret.
And here is a final provocative thought to leave you with, based on those special considerations we discussed. Yeah. DCA works like a machine. It executes perfectly every time. But that machine is bolted to the deck of a ship, the market. We're betting that the ship will keep floating and moving forward.
Right.
So the question isn't, does the math of DCA work? The math works. The question you have to answer for yourself is, do you believe the market will eventually go up? Because if you don't, no amount of averaging will save you. But if you do, if you believe that over time we build value, then why are you waiting to get on board?
That is actually a little profound. Are you betting on the rise? I think most of us are, whether we realize it or not.
We certainly hope so.
Well, there you have it. The boring beauty of consistency. Stop staring at that buy button, stop trying to be a psychic, and maybe just set up an automatic transfer instead. Thanks for diving in with us today.
A pleasure as always.
Catch you on the next deep dive.